All right, this week I want to talk about something that we refer to as the Blacklist, or to me, they're a list of America 1.0 companies. In other words, companies that I like to say where the destination is certain, which is zero. In other words, the stock prices of these companies, in my judgment, in my opinion, remember, this channel is opinion, information, not financial advice, is zero. In other words, these companies are going to end up going away. They'll go away in slightly different ways. Some of them will go away through bankruptcy, like Sears. Some of them will go away through merging with the survivors in this business. The others will just slowly disappear out of sort of like the public eye slowly over time. The only question is time. As I like to say, the speed is unknown. So this week, I want to talk about what are the companies that are on the blacklist, and if you want to get the list of the companies that are on this America 1.0 blacklist, well, sign up for Bull Profits, which is the free email newsletter that we send out to people, and we will include a link where you can get a copy of the companies that are on this list. So just to warn you that many of the companies on this list are considered to be blue chips. The vast majority of them are in the S&P 500. A lot of them are even in the NASDAQ 100, and they're considered to be bellwethers. Many people will swear by them. Many people depend on them for dividends and other things. And some of them have stock prices that have been going up for a very long period of time. However, I believe that these are dangerous stocks to own, and here's how you can identify them. All right, so a few points here. Number one, when you go and look at what they do, an America 1.0 company, a blacklist company, has a product or service that really has not been innovated on for a very, very long period of time. In other words, they're more or less selling the same thing that they have been selling in some cases for 30, 40, 50 years. In other cases might be just for 15 or 20 years. Just remember, we've seen an extraordinary amount of technological innovation, demographic change with the coming of the millennial generation and Gen Z. So the idea that these companies are still largely selling what they were, 20, 30, or 40 years ago tells you that their mindset is completely wrong for today, and that is clearly reflected in what they're offering consumers, what they're offering their customers. And one way of determining whether a company really has a product for the current time, a service for the current time, is that if they're implementing innovation, true innovation has the benefit where the per unit cost is going down as you implement that innovation. A great example of this is Tesla. The cost of a lithium-ion battery that goes into his car is in steep decline. So over time, what you can find is that they can actually reduce the cost of selling the car. So this is a great benefit of innovation, which is the per unit cost can decline as you implement the innovation and as you scale up and as you gain adoption. And for non-innovation based companies that are sort of stuck in the past, it's the reverse. In other words, as they go to scale up or add production, what they find is that the costs are actually rising, that there are no economies of scale because obviously the product is old, the way of making it is old, and no additional sort of innovation can be brought to bear to really lower the cost and pass that benefit on to the customers. The other way that you can identify a America 1.0 blacklist company is that the company is seeing no top line sales growth. In other words, you go look at revenue or sales, the sales of these companies are modestly positive at best, or else in decline by 2%, 3%. And the other check that you want to do is see that if you strip out price increases, would they be able to actually show a sales or revenue increase? Because the moment you start to increase prices in a very significant way, you start to lose customers. A number of people will simply be like, well, there's either not enough value there, or else I'll go to a competitor that's not doing it. So or else you're just simply starting to lose customers and you're offsetting that by lifting prices, and that's a sign of weakness. So if you go and look at the top line is sales and revenue, and you see that the company is in decline, or it's now really relying on price increases to get that top line to show an increase, that's another sign of an America 1.0 company that is really in decline. It's just hiding its decline by being able to lift prices. The next thing that I would tell you that points to an America 1.0 company is that the company is borrowing large amounts of money from the bond market to buy back stock. In other words, interest rates are low, and what they are doing is effectively taking their assets and in exchange borrowing money. And with that, they're buying back stock at very, very high prices to keep these stocks at very, very high levels, which of course keeps other investors in there. And they're making a bet that they can just continue to keep doing that, keep borrowing money, buying back stock, keeping it in there at that level. However, if the first few points are correct, which is that they have a product or service that has not been innovated on, that's losing market share, that is losing demographic appeal from the growth elements of the market, well, that's a bad assumption, because ultimately all of a company's finances have to be paid from the top line. If you don't generate sales, well, then you don't generate any profits, you don't generate any cash flow. So the long-term source of the bond market as being a source of funding for this is in serious jeopardy. And so this is a very dangerous thing, which for now looks fine because the stock prices are high and no one is particularly concerned about this. However, I would tell you that it's something definitely that you should go and check and see. Is the amount of bond borrowing from a company rising, and is it being used to really buy back stock and to support stocks at very high levels? Danger sign, in my opinion, in my judgment. Another one that's related to it and is also funded by borrowing is paying very high and rising dividends. Many people love this and think that's fantastic. However, it's only a good thing to the extent that it's supported by rising sales, which then drives rising profits and rising cash flow. And you're paying it out of excess money that you don't need to reinvest back into the business. So a rising dividend driven by borrowing is a danger sign for sure. And it also tells you the mindset and priorities of the companies, that rather than reinvesting into hopefully growth projects of the company, they instead are really choosing to pay out dividends and using borrowed money. Also a bad sign and unsustainable, just like the stock buybacks. So if you look at all of these things put together, you'll find that the vast majority of sort of like the bigger companies out there, whether it be consumer companies like Kellogg or Clorox, or energy companies like Exxon and others, yeah, they fit most of this list. And in my opinion, in my judgment, these companies, well, their destiny is zero, which is that they're losing market share, they're losing mind share, and what they are doing is leveraging up against their assets to sustain their stocks at very high levels, which is fooling a lot of people and keeping them in there, and simultaneously paying out these dividends because interest rates are low and a lot of people want these dividends. However, they would obviously never hold a stock if it were going down in a very steep way. So I believe that these stocks represent an actual danger to your finances, and which is why we've been telling our readers, our subscribers, to avoid it and instead to focus on America 2.0 stocks, fourth industrial revolution stocks that are experiencing growth as a result of innovation. So you've got the reverse of this. Now, on the downside, the America 2.0 stocks, they don't pay dividends, they don't buy back stock. However, they also don't borrow money like these companies are doing. And also they tend to be very volatile because at any given moment in time, if they have an interruption in growth, sometimes people want to sell them. People also tend to actively trade them, so they tend to have high volatility. However, in our judgment, it's well worth it. And for us, we would tell you, stick to America 2.0, stick to the fourth industrial revolution, those stocks, and be bullish, be optimistic, and be positive. And I'll have another one of these for you next week. Until then, this is Paul saying